Getting very rich is predictable, not risky. Robert's view. Before going further, let's quickly review the process. 1. You. 2. Leverage. 3. Control. 4. Creativity. 5. Expansion. Many individuals today struggle financially or are unable to progress due to their limited perspective of you. Despite working hard, even highly educated individuals lack leverage. They fail to utilize any resources beyond themselves, leaving them with little control over their job, earnings, and investments. These individuals often cannot showcase their creativity in either their work or investments, merely following orders and lacking the ability to expand their horizons beyond seeking another job, a second job, or relying on promotions or raises. Consider the story of Rosie the Riveter, a cultural icon from World War II. Rosie represented the millions of women who stepped up to work in factories and shipyards while the men were off fighting in the war. These women, like Rosie, worked hard and tirelessly to produce the weapons and supplies necessary to win the war. However, despite their efforts and sacrifices, they were paid less than their male counterparts and had limited opportunities for advancement. After the war ended, many women were encouraged to leave their jobs and return home to make room for the returning soldiers. Despite their hard work and contributions to the war effort, they were not valued in the same way as the men and were relegated to secondary roles. It wasn't until the feminist movement of the 1960s and 1970s that women like Rosie finally gained recognition for their efforts and began to break down the barriers to equality in the workplace. Individuals get trapped in this repetitive pattern due to the lessons learned in school that emphasize safety and conformity over taking risks. They are hesitant to let go of the limited control they possess and instead accept low pay, and stifle their creativity to avoid the potential consequences of asking for a raise or trying something new and innovative. This fear of failure or causing disruption holds them back from pursuing greater opportunities. Many individuals cede control of their investments to supposed experts, opting to remain uninformed about their financial matters. Their self-doubts, fears, and lack of understanding about business and finances keep them captive and prevent them from taking calculated risks. As a result, they view much of life as inherently risky and are hesitant to make informed decisions about their financial future. Many investment advisors, financial journalists, and salespeople exploit the fears of those who are risk-averse, offering them investments that are the riskiest of all. They perpetuate the false notion that saving money is safe and that investing in mutual funds for the long term is a secure, low-risk option. To make matters worse, many of these same people, as well as their financial experts, think that what Donald Trump, Warren Buffett, and I do is risky. Nothing could be further from the truth. Donald Trump and Warren Buffett make a lot of money simply because they know that the end result of their endeavor is predictable, the opposite of risky. Getting rich is predictable. Besides using McDonald's as an example, my rich dad used an apple grower to explain predictability. He told me the story of an apple grower who started with 1 acre of apple trees. Planting that first acre, my rich dad said, was hard. The farmer did not have much money, and the apple trees needed time to grow. After a few years, apples appeared, and the farmer sold them. With his profits, he bought 2 more acres and planted more trees. Soon he had over 100 acres of apple trees, all producing apples. It started slowly, but he knew if he kept doing what he was doing, he would soon be a very rich man. Though this example was a very simple one, it served me well. Yes, but what about bugs or drought? Some might ask. It's a valid question, and successful business owners don't count on everything going perfectly. For example, all store owners know that there will be theft by both customers and employees. A successful business will factor in reserves for these losses in their projections and build systems to control and minimize those losses. Now I hear some cynics saying, yes, but if you plant too many trees and produce too many apples, the price of apples will come down. Yes, this is true. Bringing prices down is the object of competitive capitalism. Without competitive capitalism, we would not enjoy a higher standard of living at an affordable price. The concept of predictability is prevalent in many aspects of life. When you drive by a McDonald's, see a pair of Levi's jeans, fill up your car with gas, or play Monopoly. Monopoly is a classic board game in which players compete to become the wealthiest by buying and managing properties and charging rent to other players when they land on them. The goal of the game is to accumulate wealth through property ownership, trading, and clever tactics. and to bankrupt other players until only one player remains. Monopoly is a popular game that has been enjoyed by millions of people worldwide for generations. You are witnessing predictability in action. In these examples, you can see how businesses and individuals are able to earn significant profits with minimal risk through a predictable pattern of consumer behavior. For instance, owning more houses in Monopoly or increasing the number of franchises in a chain, like McDonald's, leads to higher profits. Understanding predictability allows you to identify these patterns and opportunities for profitable investments with limited risk. This is why I become disheartened when I hear individuals claim that investing is overly risky, or when financial advisors recommend low-risk options like savings and mutual funds. This mindset, to me, is indicative of a lack of financial education and a limited financial intelligence. Donald Trump made his fortune not by constructing a single building, but by developing numerous structures, including multi-unit condominiums, and then selling them. He follows a similar formula to the one described earlier by leveraging, controlling, creating, expanding, and predicting. Although there is always some inherent risk, he has the confidence to pursue these investments as he is in control of the process. This is the same approach I take when making investments. For example, when I buy a building, I am confident that I will receive the following 4 types of income. 1. Rental income. 2. Depreciation income, also known as phantom cash flow. 3. Amortization, my tenant pays off my loan. 4. Appreciation, the dollar is dropping in value. I place appreciation as the least significant form of income because it is prioritized as the primary goal for many investors, despite its limited importance. For instance, someone who purchases a stock for $5 and sells it for $12 is seeking appreciation or capital gains. Similarly, individuals who invest in real estate with the intent to flip the property for a profit are also seeking capital gains. However, I also place a lower priority on appreciation due to its nature as taxed income. Real estate investment, on the other hand, offers a significant advantage in the form of 1031 exchange, which allows the investor to defer paying capital gains taxes, potentially indefinitely, with proper planning. In my opinion, this tax deferral advantage makes real estate a superior investment option compared to traditional paper assets such as stocks, bonds, mutual funds, and savings. If you would like to know more about why real estate is legally the best investment of all, you may want to get Rich Dad's Real Estate Advantages, written by Sharon Lechter, my partner and a certified public accountant, and Garrett Sutton, an attorney and Rich Dad's advisor. I want you to notice that a certified public accountant and an attorney wrote this book. There is a reason for this. It requires both sides of your brain to be successful. Taking control and being creative requires both financial education and experience. Robert Kiyosaki. Again, I stress that this example of real estate and paying less in taxes is completely predictable. In 1996, the year I came out of retirement, I created my board game Cash Flow and wrote Rich Dad Poor Dad. I had no idea how successful the Rich Dad company would become. But I chose the right team, starting with Sharon and Michael Lechter. Having the right team is the best form of leverage. In the same year, I also started an oil company, a gold mining company, and a silver mining company. While the oil company failed, the mining companies went on to become public companies via IPOs and a merger. The companies are listed on the Canadian stock exchanges. Both companies have made me millions of dollars. Many people said starting oil, gold, and silver mining companies was risky. While there was some risk, to me it was very little. I could mitigate the risk simply because I know we all consume oil and gas. That is predictable. I also knew that gold and silver would go up in value. How did I know? Because I knew the politicians running our country would not stop spending, would not stop borrowing, and would not stop printing money. So, in this case, it was not gold and silver that were predictable. It was the financial incompetence of our political leaders that was predictable. They do not solve problems. They simply push the problem forward and make the problem bigger. Their behavior is predictable, and that is regardless of whether they are Republican or Democrat. In conclusion, enhancing your financial literacy leads to a more predictable path to wealth. With a solid education and experience, and a thorough understanding of leverage, control, creativity, scalability, and predictability, one's perspective on life can change, as it did for me. As a child, my rich dad had me play Monopoly over and over again. As I played, I was learning and understanding the power of leverage, control, creativity, expandability, and predictability. Suddenly, one day, after playing the game at least 1,000 times, my mind caught a glimpse of the future, a future of great wealth. I believe I was about 15 at the time, and that created a problem. Once I could see a different world, I could no longer buy into the idea of life being risky, the need for job security, and a company or the government taking care of me. The moment I saw a different future, I no longer saw life as risky, but as exciting instead, and that has made a world of difference in my life. Donald's view. The wealthy often continue to grow their wealth because they have the resources to make investments. Although there is still a possibility of making mistakes and incurring losses, the chances of success and profitability are greater for those with financial stability who take investing seriously. Lowering the risk factor in investing starts with being informed and prepared. Don't rely solely on investment advisors for advice and guidance. Take the initiative to educate yourself first, so you don't leave your investments in someone else's hands. Ensure your own success by doing your own due diligence. One famous example of an individual who took control of their own investments and achieved great success is Warren Buffett. He is considered one of the greatest investors of all time and is known for his strategy of researching and investing in companies for the long term. He famously avoids trendy investments and instead focuses on companies with a strong track record and a good management team. Instead of relying on financial advisors, he educates himself on the companies he invests in and makes informed decisions. This approach has earned him a net worth of over $100 billion. There are some great financial advisors who have made fortunes for themselves as well as other people because they know what they're doing. They have learned the world of finance well enough to excel and be on target when it comes to predicting trends. What they do will have a limited risk factor because of their experience and expertise. Again, Warren Buffett. He is often referred to as the Oracle of Omaha and is widely considered one of the most successful investors of all time. He is the CEO and chairman of Berkshire Hathaway, which is one of the largest and most profitable companies in the world. Throughout his career, Warren Buffett has consistently demonstrated his ability to make smart investment decisions that have generated substantial returns for both himself and his investors. His investment philosophy, which emphasizes long-term value investing, has proven to be highly effective, and his track record of success has made him a role model for investors around the world. The reason this chapter title says getting very rich is predictable is because the very rich part indicates that you already have money with which to work. The deciding factor is whether or not you're going to let your money work for you to become very rich. Those who know how to do that stand a very good chance of joining the leagues of the uber rich. When I build a new building, I definitely look into the risk factor, which to me is whether or not it will be profitable. I don't like taking huge risks, especially when I can do some of the predicting in my head first. When I first decided to try the hotel-condo mixed-use idea, I could already see how the combination could prove to have a comfort zone attached, as in, owners of the condos could also participate in the success of the hotel. I knew this would have a huge appeal to investors and owners because I did the math, and I knew that idea would appeal businessperson to me as a whether I was the builder or the investor. My risk factor and their risk factor had been lowered. It became more predictable, but I will admit that I was surprised how successful the idea became. The biggest risk we all face is not moving forward with what we've learned. Donald Trump. My father always emphasized that certain things are predictable, namely that intelligent work will result in intelligent results. He was a hard worker and he always said it saved time to work intelligently from the beginning. I began, at an early age, to learn to assess things in my mind first, before going off to see if they might work. That took a lot of the guesswork out of the process, and therefore a lot of the risk. It also saved me a lot of time and money. The leverage I had was a knowledge of construction and the good fortune of good instincts. I had also studied real estate for many years. Years ago, when I decided I was fed up with New York City wasting years and many millions of dollars trying to rebuild Woolman Rink in Central Park, I predicted how long it would take me to do it and how much it would cost. I turned out to be right. I had it done in a few months and at $750,000 under budget. To me, that was predictable, and doing it was not a risk. It was watching it never getting done that was a risk to my health. Becoming very successful can also be predictable, especially if one will take the occasional risk. I had to be convinced to do The Apprentice by Mark Burnett. Having my own reality show was new territory for me, and the odds for new shows are not the kind I normally like too much. 95% of all new television shows fail. I was already successful, but after The Apprentice became a hit, I was even more successful. The goods were there, which stood in my favor. The same thing applies to money. It's true what Robert says about leverage, control, creativity, expansion, and prediction. Being multidimensional and alert on all those levels can be exciting and will produce results. If people think that's risky, so be it. To me, it's a great and exciting challenge. You can change your world if you want to, and by doing so, you might be making a great contribution to the world at large. That's worth thinking about. The biggest risk we all face is not moving forward with what we've learned. Expansion has many dimensions. I'll conclude with some advice from Abraham Lincoln. I don't think much of a man who is not wiser today than he was yesterday. Abraham Lincoln. That's a good incentive to pay attention and apply what you've learned on a daily basis. If you do, my prediction is that you will be meeting with success before too long. Getting rich is predictable. Remember how we said Albert Einstein defined insanity as doing the same thing over and over again and expecting different results. Albert Einstein. For you to become rich or richer, you may need to change what you are doing. Make a commitment to yourself.